All
Hey,
right, welcome to the Payback Agency call here. Today we're going to train on taking the financial inventory and transitioning into an app. Okay, so I'm going to share my screen here. And before I do that, let me actually do this. The way I do this is pretty simple. I mean, the first and foremost, what I'm going to do is I'm going to have some information about the client right off the bat. When they come in as a lead, I'm going to have a little bit of the information. What am I going to have? I'm going to have their name, right? If it's a mortgage lead, I may have their total payoff on their mortgage, okay? And then if it's an IUL, I might have their birthday, right? But that's all the information I'm going to have. And so when I do that, I'm going to write down that stuff down on my financial inventory sheet. Okay. Here it is. Can you guys see that okay? Nod your head.
yes.
Yeah, cool. Right on. So this is what it looks like. So let's say that the lead comes in and now the name of this is, let me ask you this, Josh, can you be my client?
Yes, sir.
All right. So I'm gonna write down Josh's name. I'm gonna have that already in there before I call the client. Let's say this is a mortgage lead and he owes $340,000 on his house. And so I call up Josh and I'm like, ring ring.
Hello?
Hey Josh, this is Shawn Simpson here. I got you on the schedule here to talk about mortgage protection today.
Okay. Yeah. How's it going, buddy?
Good, 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 good. What got you interested in mortgage protection? I'll just kind of open it up to you.
Yeah, so I mean, I just saw the ad for it, and it kind of hit me right between the eyes that, I don't have anything like that put in place, so I just kind of wanted to get some more info on it.
Okay. Okay. Have you ever had any type of mortgage protection before on your house?
No.
Okay. Okay. Do you have any type of life insurance product in place right now?
I think I have something like 100,000 through my work and like 10,000 through my auto insurance or something like that.
You got 100,000 through work and then 10,000 through auto. Interesting. Okay. No problem. So right now, time out. I'm just trying to find out information, right? I'm trying to get him to talk to me, sell me on why he needs insurance. Also, I'm trying to find out how much he wants. I'm trying to find out how much why he needs it, right? I'm trying to figure out the pain points and I want him to tell me those pain points. Okay. And if he doesn't tell me those pain points, I'm going to start to draw it out a little bit. Okay. So, Josh, let me ask you, have you ever applied for any type of a life insurance product before other than the 10,000 that you have through your auto?
No, I don't think so. I think I put something in my cart once, but I didn't go through with it.
Okay. Do you know the difference between mortgage protection, life insurance, and regular life insurance?
Mortgage protection pays off your house.
Yeah, it's supposed to. Yeah, if you qualify for it. Life insurance, if you die, it pays off, you know. I'm not sure if you knew this or not, but about 7% of those only really pay out. And the reason why is because most people outlive the policies because they're usually, not all the time, but they're usually term policies. So if you think about a term policy going for 20 years and you keep paying on it and you don't and you outlive the policy, a lot of times after that, you're uncovered and you just don't get your money back, right? So it's not that the carrier doesn't want to pay out, it's just that the most people outlive the policy. A mortgage protection policy, if you get hurt, you get sick, you get injured, it pays off the mortgage. You can pull from the death benefit. It doesn't necessarily always pay off the mortgage. It depends on who you apply for or how much you apply for. But you can pull from the death benefit while you're still alive to sustain some cash if you get hurt, sick, or injured. And then if you do die, it allows your family to have a death benefit to use towards that mortgage payoff. Let me ask you here. It looks like your mortgage is 340,000. Is that correct?
Yeah, that sounds about right.
And then is that a 15, 20, or a 30-year term?
That's a traditional 30.
30. Okay. And then when did you buy that house? Or is that a refinance?
Yep, just bought it last year.
You did? Okay.
Yeah.
Congratulations on your new purchase, by the way.
Yeah, thanks.
What's the value of the house? Do you know?
Yeah, it's got a pretty good deal. A little bit of a fixer-upper, but it's valued at 375 actually.
375. Okay. Now here, this is where I do the math and I calculate timeout, right? Side note here. This is where I calculate the math and I'm going to tell them how much equity they have and then I'm going to put a little plug in there of why they need insurance, right? So I'll say, okay, 375 minus 340. So that's about 35,000 of equity there. That's pretty important to protect. I'm sure if you were to pass away, you would want that equity to go to your family, right?
Right. Yep.
So of course he's going to agree with me, right? So I'm just putting I'm getting a little bit of a yes along the way so that once I get down to the bottom, he just really wants this thing so bad, right? Once I get to the end of it, he just really wants it. And then how much is your monthly payment?
It's about 2,500.
Okay. And then does that include, is that your pity payment, your principal, interest, taxes, and insurance?
Yeah, it's all rolled together.
Okay. All right. Now, what I'm going to do here in the financial inventory, it's not set up all perfectly. This right here, you can just pull off of the site and you can copy as many of them as you want. But what I like to do is right now, if I don't have his date of birth, I'll just kind of transition into talking about all of this stuff right here. Okay. And so I'll ask him, I'll say, Josh, well, I'm going to tell him off the bat, I'm sure you'd know that you can't just go buy this type of coverage. You have to actually qualify for it. So what I'm going to do here is I'm going to take about 5 minutes, ask you some finance questions. I'm going to ask you some medical questions. From there, I'm going to have an idea of which one of those carriers may qualify you. And then what we need to do is get you in front of that carrier. And by doing that, we're just going to submit a simple request to the carrier. Okay. Now, I'm time out. What did I do there? I just kind of explained exactly what's going to happen next. I'm telling him that we're going to fill out an application without telling him I'm going to fill out an application, right? How do we get him in front of a carrier? Well, we're going to submit a simple request. And notice how I said it. I always emphasize simple, right? We're going to submit a simple request to the carrier. And that's the word that I want them to hear. Simple, right? We want to make it everything as super simple as possible. We're doing this over the phone. We want to keep it simple and keep it quick, right? So now he knows what I'm going to do here in the future. I'm going to ask him about his health. I'm going to ask him about his finances, and then we're going to submit a request to the carrier. Okay. So, Josh, when is your birthday?
It's March 4th,
March 4th,
1990.
1990. Okay. And so that makes you what? 34?
34.
All right. And then what's your height and weight?
I'm 5'9", 160.
5'9", 160. Okay. And then what do you do for a living? What's your occupation?
I'm in construction.
All right. Are you a laborer, business owner?
Yep, I'm a laborer. I'm the job site's custodian.
Okay.
I'm in the
And
union.
are you married, single, divorced, widowed?
I'm married.
Okay. What's the wife's name?
Caroline,
Caroline. Okay. And then what's her date of birth?
6/8, 1994.
6/8/94. So she just turned 30.
Mm-hmm.
All right. And then what's her height and weight?
Oh, geez, that's a mystery. She doesn't tell me. We don't allow scales in the house, but I'd say she's probably about 5'5", 115.
5'5", 115. Okay. And then what does she do for a living? What's her occupation?
She is a author.
An author. Okay.
Yeah.
Super cool. Okay. Now, time out. Now I'm going to start getting into the income, and I might use this to show him another reason why he needs this type of coverage. Okay. And so I'll ask him, I'm going to start asking about the finances. So, Josh, what is your monthly income take home after taxes?
Um, Take home's about 3,200.
3,200. Okay. And then how about Caroline? What's her monthly take home on average?
I'd
What is it?
say I'd say maybe 500.
About 500 bucks?
Mm-hmm.
So, ooh, man. So if something were to happen to you, Caroline might have a difficult problem making that $2,500 mortgage payment out of 500 bucks, right?
Yeah, I guess you're right.
Yeah.
I yeah.
What would happen if you got in a bad car accident, ended up, I know you have life insurance but what happens if you're laid up in the hospital and you don't die? You can't go to work. They still going to pay you if you don't go to work?
No, I think that, geez, I don't usually think about that, but I usually think about getting hurt on the job and then there's workman's comp but I'd say if I don't get out of the hospital and get back to work within probably 30 days, I'm probably going to lose my job. But even taking 30 days off is going to hurt us financially, drastically, like dramatically. So
Well,
I don't,
workman's comp might pay out as well. But usually that they investigate, and sometimes that investigation can take 90 days to 180 days, and if you're laid up in the hospital, is you going to be able to stay in that cash? Probably not, but that's
probably
why we're
not.
on the right?
I mean, right. It's best
Okay.
not to, risk it because, well, I mean, we always figure out a way to survive and make things work when things get hard, but it's at that point we always kind of wish we had something in place.
Well, the reason why I bring up car accidents is because they're the number one cause of death in America. But I've been in 7 car accidents in my life. I'm not dead yet, but some of them are pretty scary. And if you're laid up in the hospital, not going to work, Carolyn's probably going to do daddy duties around the house, and she's also going to take care of the kids, run them all over the place. But she's also now going to have to start taking care of you for when you get out of the hospital. So that's why I kind of bring that up because most people don't think about that. And $2,500 is hard to come with if you only have $500 coming from income from her. Does that make sense?
Hmm.
Yeah. Okay. Um, if you don't mind me, well, the next question they have here is what is your monthly expenses? I mean, ballpark, if you were to add up like your car payment, if you have one, you know, gas for the car, insurance, food, utilities, credit card bills, date night, you know, Netflix. If you were to add all that up, ballpark, what is your monthly expenses?
Um, Probably about 2,800.
About 2,800?
Mm-hmm.
Okay.
Give or take.
So if my math is right, with your income at 3,700 between the both of you and expenses about 2,800, so that leaves you about $900 a month extra. Does that sound right?
Yeah. Mm-hmm.
Okay.
I don't know where it
You guys
goes,
ever,
but yeah.
okay. Do you guys ever do anything extra on the side to pull in some extra cash?
Yeah, but I can't legally talk about it. Just kidding. No, we don't really have any side gigs or anything.
Okay. No side gigs. So you guys are living off of about a little bit of extra 900 bucks a month, roughly.
Um, yeah, yeah.
Okay. So now, time out. I'm going to shoot all the way down here because this we're still talking about finances. So now I'm going to ask him. So is there any type of 401ks, IRAs, stocks, bonds, mutual funds, CDs, anything that would offset the mortgage if something were to happen to you?
No, I don't. Sean, do you want me to give an example where I do?
Sure.
Um, yeah, I think that I have a 401k through the union. Yeah, I think there's about 75,000 in it right now.
You got 75,000. Okay.
Hmm.
And that's with the union that you work with, correct?
Right.
Okay. Okay. So, time out. The reason why this is important is because if they have extra money in a 401k, IRA, stocks, bonds, mutual funds, something like that, and they can't qualify for life insurance due to health reasons, they can always roll this money over to a fixed indexed annuity, and there's no health questions involved in that. As long as they're financially suitable, then they can have a fixed indexed annuity, and that and in an annuity, I'm getting tongue tied here. You can participate in the gains, you never participate in the losses. Okay. Now, every situation is different, um, but I just wanted to kind of point that out there. So, okay. So we got all these questions, all the finance questions out of the way. Now I'm going to start turning to the health questions. Josh, are you a smoker?
No,
Okay. What about Caroline? Is she a smoker?
no.
Okay. Good for you. When did you stop smoking?
Um, about 7 years ago.
Okay. Cool. Do you use any tobacco products? Vape, cigars, anything like that? Do you chew?
No.
Okay. And then what prescription medications are you on?
I'm not on any prescription medications.
Zero?
Zero, indeed.
Okay. Have you taken any prescription medications in the last 5 years that you maybe the doctor gave them to you and you said, you know what? I just feel great. I'm not going to take this anymore. Or maybe they took them off your chart.
No, nothing. I
No.
more of a alternative medicine guy myself.
Okay. Super cool. Any surgeries or hospitalizations in the last 5 years?
Nope.
None? Okay. Super cool. How about mom, dad, grandma, grandpa? Has any of those died before age 60?
Um, Grandpa, I had never met him. He died when he was about 50 from a heart attack.
About 50 from a heart attack? Okay.
Hmm.
Okay. And then anybody else?
Um, nope, nobody died. I've had some family members get cancer, but they didn't die.
Okay. I'm going to run through some medical questions here. Have you ever had a heart attack, stroke, mini stroke, cancer?
No.
Any stents ever put in?
Nope.
Okay. Any diabetes or neuropathy?
No.
Okay. Any high blood pressure, lupus, rheumatoid arthritis, asthma, COPD?
No.
Okay. Any thyroid issues or anxiety, depression?
No.
Okay. Any kidney or liver disease?
No.
All right. Um, any felonies or misdemeanors in the last 10 years?
No.
No? Okay. Okay. So now right here, time out. Notice this lead came in as a mortgage protection lead, right? But I'm looking at his health here, and his health is pretty good. He's 34 years old. He may qualify for an IUL, okay? An index universal life. And an index universal life is like a mortgage protection policy on steroids, meaning that it's like a term policy or a cashback policy that's going to have all the living benefits, but on top of that, it's going to grow your money tax free as well. Okay. So I'm going to kind of position it that way. So what I'm going to do is I'm going to ask him, hey, Josh, let me ask you this here. You, out of the 30 carriers that I have, and I'm going to position it like it's pretty hard to get, right? Um, Out of the 30 carriers that I have, there's a few of them that have an IUL and that you may qualify for. Obviously, we don't know because, you still have to submit a request to the carrier. So I'm taking it away, right? I'm putting it out there, but I'm going to take it away. But have you ever heard of an IUL?
No. What is that?
So an IUL stands for Index Universal Life. Um, I call it the financial pocket knife or the financial Swiss Army knife. And the reason why is because if you think about, a Swiss Army knife, it has multiple purposes, right? You have two blades, they're different sizes. You have tweezers, you have toothpick, you have, corkscrew, you have a little saw. There's multiple purposes of it for one tool. Okay, that's like an IUL. So it protects your family when you're dead. Okay. And that's just the cherry on top. All the other benefits I'm going to go over are for you while you're still alive. And so it also protects you if you get hurt, sick, injured. You can't go to work. You can pull from the death benefit to sustain some income. But it also, here's the reason why most people like this, especially the rich. They've been using this for years, right? You can use it to grow your money tax free because it's indexed with the market, not in the market. So, like your 401k can go up and down, and IUL, it can only go up. When it goes up, you participate in the gains, you never participate in the losses. So here's an example. When the market goes up 12%, you get 12%. Market goes up 15%, you get 15%. Market drops below zero, like it did in 2022. I have clients that lost 15 to 20% in their 401k. Zero is your hero here. You don't lose any money. You get to keep all the money that you got. You don't gain any money that year because nobody else did either. Everybody else lost money, but you don't lose anything. You get to keep everything. It also avoids probate when you die. And it also, if you grow it large enough, you can supplement a tax-free retirement when you retire. And if they're built properly, you can use that for the rest of your life. Okay. Does that make sense?
Yeah, wow, that's a lot.
Yeah. It's a little bit better than an average mortgage protection policy, right?
Yeah, yeah, that's a lot more robust than what I was thinking.
Okay. So is that something that you would want to protect your
Yeah.
family?
Yeah. Interested in, what it would cost and everything, but
Sure.
that's,
Yeah.
I mean,
That's a
all that sounds
that's
good.
That's a great question. Now, a normal, now here's the way I transition into getting into, now if I'm going to go with an IUL, chances are I'm going to go into an illustration, right? If it's going to be a big one. If it's going to be a smaller one, 100 bucks, 200 bucks, I may not show him an illustration. I may just let him know he's going to grow cash value. And I may look at the illustration myself and just say, yeah, it looks like, by the time you're 65, you'll have blah, blah, blah in there, right? So I may not show him an illustration. If it's going to be a big one, I may, and I'm going to show him an illustration. Here's the reasoning behind showing him an illustration and not showing him an illustration. By showing him an illustration, you're going to lengthen the call to at least another half an hour. Because if you're going to go through the whole illustration, you're going to explain everything in there so that they completely understand it. And if they're going to spend 500 bucks, $1,000 a month, you're definitely going to want to make sure they understand it, right? But if they're going to spend 100 bucks, 200 bucks, it's not that big of a deal to them because they're not going to grow a ton of cash value anyways. And so in that case, I might put them in an ethos policy, a Marico policy, or a Mutual of Omaha policy, right? And I may not show them an illustration just to speed up the call. And if I can not show them an illustration and I run an application with Marico, Mutual of Omaha, or Ethos, I can get them approved right away. Now, on the flip side of that, if he says I want to put $1,000 a month in there, I'm probably going to go with a carrier of NLG, F&G, or Columbus. Now, this guy, he's pretty healthy, right? There's not really anything here. He doesn't have any subscription or prescriptions. So I can go with almost any carrier and likely get him approved. Am I going to tell him that? No, because then he's going to decide, well, I'm going to decide when I want it, right? But if I don't tell him that it's easy for him to get approved and let him know that, you may not get approved because you never know. They may find something that he forgot about and not get him approved, right? If I don't tell him that and act like, it is pretty hard to go through this whole process, then he's going to want to go through the process because people, want what they can't have. It's just our nature, right? So here's how I find out how I'm going to transition. This is how I'm going to transition into an IUL and find out which carrier I'm going to go with. Again, he doesn't have any medications. He's pretty much open everywhere. Okay. Now, if he had medications, it'd be a different story. I would go on the term cheat sheets and I'd find out what Americode takes, what Moo takes. A lot of that also is still going to dictate how much he wants to put into it. So this is how I do this. Now, this is where how you say it and what you say becomes important, right? This is what I'm not going to do. I'm not going to say, hey, Josh, how much do you want to pay for this? That's the worst thing to come out of your mouth, right? Why? Because now they're thinking of how much do I have to pay, right? Pay is a bad word. When they pay into their 401k, they're not thinking about how much they have to pay. They're thinking about how much they're contributing to their own retirement. And so that's how we want to preface this to them. Okay. Now, you can protect your family and you can also grow this for tax-free retirement to supplement a tax-free retirement, not for a tax-free. We always say supplement a tax-free retirement because we don't want them to think that this is the only thing they're gonna live off of for the rest of their life. That may not be the case. I mean, something may happen and who knows, right? So we always want to use the word supplement. So the way I kind of preface this to all of my clients is I'll say, okay, Josh, the next step, remember, we're always telling them what the next step is going to be in the future. Okay. The next step is we need to get you in front of the carrier. Okay. So by doing that, I need two numbers from you. It's not like a term policy where, you tell me I need $500,000 to pay off my mortgage, or in this case, 340,000. And I tell you, it's going to be 500 bucks a month, right? That's not what this is. This is something more on the lines of how you put into your 401k, right? So I need two numbers from you because this is flexible. I want you to think about a whole year's worth of your financial situation. On the worst month ever, where you have more bills than necessary, the wheels are falling off the car, you got some extra expenses. What is the minimum number you would want to put into this? Okay. And then on the flip side of that, 11 months out of the year, everything's going great. Everything's financially perfect. In fact, you just got a raise, possibly. You got some extra money coming in. Husband, wife's doing great. And you're going to use this to help supplement your tax-free retirement, right? Now, keep in mind, there is no cap on this, right? Like your 401k, the max you can put in is 23,000 a year. Big whoop, right? What's that going to do for you? I have clients that put in $1,000 a month on this thing. I have clients that put in 2,500. I have clients that put in 10,000 a month. So if you were to stretch a little bit, what is the max that you would want to contribute to your tax-free retirement and use this to protect your family as well? What's that number that you would want to contribute every month?
Well, I'm contributing to a 401k already right now,
Mhm.
and so part of my wages are going into that right now. And I have 900 give or take every month. Some months I work overtime, some months I work less. My wife doesn't always bring in 500 a month. And even when we do have a surplus of 900, it doesn't seem like we're ever able to save it. So I'm not totally sure what the max would be, but I'd say that, four 400 would probably be doable at that, realistically.
Is that the max or the minimum?
That would be the maximum.
Okay. And then what would be the minimum?
Minimum, well, I'm not sure exactly what it would cost to actually have the house being paid off. Do you have an idea of what that might actually cost to have the house paid off?
I can
To still,
actually do one better.
okay,
Once I get I got the one number, but once I get the other number, I can actually plug the numbers in and give you a solid death benefit of what they would provide to you once I plug that in there. And
okay,
it's always adjustable. We're going to customize this to fit you, okay?
okay. So yeah, let's look at like 175 and 400.
70. Okay. Now, time out, right? Now I got the two numbers. The lower number really doesn't matter to me, okay? What really matters is the max. Okay. Now, since it's $400 a month, I may go with a company called NLG, F&G, or Columbus Life. Why? Because it's over 10 times his age. Okay. 10 times his age is the rule of thumb. And the reason why is because if it's less than 10 times his age, then it's not going to grow much cash value anyways. And so we're going to gear more towards the protection focus. And that could be a Marico policy. It could be a smart solve on Ethos. It could be an IULE with Mutual of Omaha, right? But since he said $400 a month, it's over 10 times his age. And so now what I'm going to do is put some stuff together. I'm going to reschedule the appointment because now I want to draw an illustration, right? And so I'll say, okay, what I want to do here is let's reschedule, Josh. And what I'm going to do is put some numbers together here for you. And then once we reconvene, I'm actually going to send you a link and share my screen with you and run a spreadsheet. We actually call it an illustration. And that's going to be able to show you all the numbers of how much money you can have in retirement through tax free through a life insurance policy that's also going to be used to protect your family if something happens to you and if you die. How does that sound?
Okay, sounds good.
Okay,
Excited to see what you come up
perfect.
with.
And then what I'm also going to do is shoot you over a video to take a look at that talks about IUL. So I'm going to do a little bit of homework. In the meantime, when we reschedule, can you do a little bit of homework and watch those videos for me?
Sure. Yeah,
Okay, perfect. Sounds good. Okay, and that's how I kind of transition into the IUL. And then I'll set another appointment. And then once I get on that second appointment, what I'm going to do is just kind of go over my notes again. I'm going to go over it in summary and I'll say, okay, Josh, last time we spoke, it looks like, based off of your income of $900 a month, you said you may want to put in max of about $400 a month. And you said you want to put in a minimum of 175 a month. Is that correct?
Right.
Yeah. Okay.
Yeah,
So
but we were
let's
going to kind of look at the numbers and kind of see what, if 175 would even, cover the full mortgage.
Right. Yeah. So what I would do is now in timeout, right? So now what I'm going to do is I would jump into an illustration and he notice what is he saying to me? He's saying literally more about the 175, right? Now I know he needs to be about 10 times his age. Okay. So what I'm going to do is I'll say, okay, how about instead of 400, let's run it for 350 and see what that does. Okay. This is customizable. We can change it in a blink of an eye. It takes literally like 5 seconds. It's just an illustration. And then, of course, he's going to be like, okay. And I look like the really good guy, right? Because I'm not going to max it out right here. I'm not going to say, let's run an illustration for 400. He's already him and Han to me that, 175. I want to see the numbers on 175, right? Well, I know that 175 is less than his age, less than 10 times his age. So he's not going to grow much cash value. Okay. So I may run it at 350 and see if he likes it. If he likes it, no problem. Great. Then what I would say is at the end of the illustration, all I'm going to ask him is one question. Well, hold on. Let me back up. So once I get into the illustration, remember, we're also preparing them for the next steps, right? So right before he clicks on the link and looks at the illustration, because I'm going to share a link with him so he can see that on my computer. I'm going to tell him, okay, we're going to look at this illustration. I'm going to explain it to you. And then after we're done, the only thing we have left to do is to submit a request to the carrier to see if we can even get you approved, right? Because if we can't get you approved, then we're doing all of this for naught. Does that sound fair?
Hmm.
Yeah. Okay, cool. Now he knows what we're going to do, right? So now I'm going to go through the whole illustration, explain it all to him, and I'm just going to basically ask him at the very end, hey, do you like the IUL? And 9 times out of 10, I mean, I think I've had one out of 100 of them that I've done that says, no, I thought I was going to make more money than that. And this guy was like 63 years old. So, of course, right? you know, but 9 times out of 10, they're like, yeah, I like it. Okay, great. And then you just go right back, get into the application, start filling it out. Okay, great. Let's get into the application and send in the request to the carrier. Okay. Yeah, let's do it. Right. And that's how I do it. That's how I do it every single time. Now, if he, if he comes back and he would say, you know what, I can't do 350 a month. Then since I'm already in the illustration with NLG, I probably would go down to like 200 a month or 250, even though I wouldn't start there if he told me that number. And the reason why is, I'm already in the application, I'm already in NLG. Now you can, if you want to, pivot to another carrier that's going to be more protection focus. And what I mean by that is they're going to be putting more cost of insurance to the death benefit and the cash value. I'm sorry, the death benefit and the living benefits than the cash value. And that would be like Americo or Mutual of Omaha, right? So that's kind of how I would do that if he said that, 350 bucks was too much money. Okay. Um, any questions? Let me just open it up here.
Yeah, there's Sean. What is the links for the videos that you referred to? I've heard that a couple times, but I
Do you have Lead Champ
there's
Pro?
yes, I do.
Yep. So it's under action. It's on
Okay.
the action button, and then click
hmm
on IUL,
hmm
and then it'll just automatically send out a text with a link to the videos.
Okay, and I can test that myself and have it sent. Okay,
Yeah.
cool beans. Thank you.
Yeah. Any other questions?
Yeah, so it was my understanding that when you do a transition from traditional mortgage protection to an IUL, that you just put in their death benefit on an easy solve and solve for premium.
You
And
can.
so,
You can
okay.
definitely do that. You can solve for premium. Um, 9 times out of 10, though, again, if they're putting in more than 10 times their age, that death benefit is going to be higher than their mortgage, anyways. 9 times out of 10. Not every time. I'd say maybe 8 times out of 10. And so, if that's the case, they're still going to build cash value more because it's set up that way. But you're also getting enough death benefit in there to pay off the mortgage if that's the case, right? So, but if you're going to put in 175 a month, probably not. That's why I would go, I'd probably transfer it over to Protection Focus, put in the amount that they want, and I'd say, okay, the minimum you can do to pay off your mortgage is this amount. Or you transition over to Americo or Mutual of Omaha or Ethos.
Okay. Now with an NLG protection focus, I've noticed that the death benefit, the contractual death benefit is typically low, but then there's an additional rider for additional death benefit. Have you seen that?
Yeah.
Do you know what that's about and why it's structured like that?
Because they're trying to give you the lowest cost of insurance for that. And so here's your cost of insurance, but they have a range in there and you can't see it. I don't know. It's on the back side of, I don't know the actual range. You could probably
Sure.
call NFG and they'll tell you. But they have a range in there of the base amount of death benefit to where in order to get what they need, they can actually give you more for free and give you that extra death benefit to cover that for the same price as the base benefit.
Hmm.
That's my
Okay.
understanding. And I
Um,
may not be 100% sure on that, but that's my understanding.
Now, in the scenario that I've given you, a guy who's just kind of working a day job, maybe doesn't have a whole lot left over, and in his mind, he's putting money into a pension or 401k or whatever his union is offering him. What if he's not too concerned about, supplementing his retirement? And so, like, do you feel like maybe you want to gauge that first before you like jump into talking to him about retirement, or do you want to go to the retirement first, see if he bites, see if that's interesting to him, and then kind of go from there?
Yeah, you can do that if that's the way you want to do it. I like to, I just start talking about retirement as well because we're already talking about death benefit. We're already talking about living benefits, right? So if I start talking about retirement, that's just the cherry on top, right? It's just another added benefit that they're getting with the same type of a policy that they had no idea that they were getting anyways. I mean, when you first got on the phone with me as a client, right? You think, well, I got to get a term policy to cover my mortgage. And if I die, it pays out. They don't know anything about living benefits, right? So that's a big plus right there. And so then we're talking about how this is going to be, pay off the mortgage if you die, but it's also going to pay you if you get hurt, sick, or injured. And then later on, I say, okay, have you ever heard an IUL? Blah, 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 blah. Talks about, it's like a 401k, blah, 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 blah. And then all of a sudden, now it builds cash value, right? Now I ask you how much you want to put into this, and you tell me. And I have no objection about what price is. Why? Because you told me the price, right? Now, if you say, I'm just going to put in $200 a month, I'm probably going to go with Americo because they'll give a high death benefit, right? And
Hmm.
sometimes that is, even more beneficial to them. And I'll say, look, they're going to give you, 450,000 for that. And plus, you get up to 100% with critical, chronic, and terminal. And it builds cash value, right? I'm just going to emphasize the benefits that are going to benefit them the most, right? But if I'm in NLG, I'm going to emphasize how it builds a lot of cash value because we're going to design it that way. But usually when I'm in there, though, I'll talk about it at first to build it up. But when I'm in there and I'm talking and they see my screen and they see protection focus, balanced death benefit, and min max death benefit or max cash value minimum death benefit, I'm going to talk about all three of those and they get to choose. And that's how I do it with them on the screen. And usually they pick the max min, right? So I'm trying to help them understand that you're going to, you thought you were going to get this, but you're going to get this, plus this, plus this. And guess what? You may not have a big retirement right now, but guess what? Now you can add a little bit of income for retirement. Or what happens if you get in a pinch 10 years from now? You can pull some money out to borrow from, choose to pay it back or not pay it back until you're dead. Does that answer your question?
Yeah, absolutely.
Okay. Any other questions? No? Sweet. Let's end it up. Grady's about to start his call. It's at fflwatch.com. Y'all have a good day.
Thank you.
Welcome.
Thanks, Shawn. You too.
Thank you.
Thank you.